In 1930, when the Fed cut the interest rate, the market crashed further. In today's tutorial, we will be comparing the 30s and today's market to identify some of their similarity and where exactly are the interest rate direction pointing us moving forward. As we may have read that many analysts are forecasting that there will be a few rate cuts in 2024. But is this really the best option? My name is Kon Hao. My work in this channel, as always, is to study behavior science and finance, discover correlations between different markets, and uncover potential opportunities. And before we discuss about this topic, please do take some time to read into the disclaimer. And let's look at what happened to the pre-Great Depression. It was a period where many investors are heavily invested in stocks with margin. With margin, I'm also referring that they borrowed money to invest into the stock market. And this caused the market to have an assets bubble or the stock bubble. And the bubble crashed in September 1929. And this led to another crash called the banking crisis. And it took the Fed back then about 2 years later to finally cut the interest rate from 5% in 1928 and 29, and it cut in August 1930 by 50 basis point, and it continued to ease the interest rate, but we can see that it didn't help the Dow Jones or the stock market. It continued to plunge. And this was then the discount rate. And of course, today the discount rate is still in use, but we also refer it to as the Fed fund rate. And we can see that the discount rate then at a high was in the 1929 and it started to cut and ease off into the 30s. And what I'm going to do here next is to do a hypothetical study in pattern recognition. And we're going to compare to the 20s and 30s, the interest rate, to the last 40 years interest rate, the 70s, the 80s into the millennium. And we're going to do some pattern recognition to see whether we can get some clue where the interest rate is heading. And in the 80s, we can see here is that the interest rate reached its high at about around 20%. And into the millennium, from 80s in the millennium, we could see a general trending down of this interest rate, a decline of interest rate until March 2022. The interest rate finally broke above this downtrend line. And in all analysis, I always ask myself, where is the trending of the market? Now, what do I mean by this? And let me just demonstrate to you what I mean by that. And my question to myself is that where is the trending of inflation or interest rate? I'm seeing this. The trending of the interest rate after March 2022, it seems to me that it's trending higher. So in between, the market will move in jagged. I'm not surprised that there'll be some cut, but maybe a few cut, maybe inflation start to pick up again. The Fed may hike the interest rate once again. And that's what I'm seeing here. And I want you to remember the last few decades, which is 4 decades of interest rate. And I'm going to do a comparison to what happened to the 20s and 30s. You'll see a lot of similarity compared to the current and the 20s and 30s. So again, in the 1920s, we could see that the interest rate peaked. And along the timeline, it have kind of developed into this decline trend. And in 1928 and after, it broke above. And then it went to a high, it did a retracement, it reached a new peak before the stock market crash. And subsequently, 2 years later, the Fed finally decided to cut the interest rate, but it didn't help. So where are we today if I'm just going to do this comparison? And I would say that today could be here. Have we reached the peak of interest rate? I suspect not yet. So could be that the next few months to come, we'll see some ease of interest rate. But again, I want to be mindful about this term. Where is the trending of interest rate today? And we're seeing that the trending of interest rates moving higher. And in this context, how are we going to manage our risk and position. Now, this is what I'm going to utilize, which is the 2, 5, 10, and 30 years yield, which is the interest rate market. And what we're seeing here on the upper window is the cash market, and the lower window is the yield futures in CME, and how you trade and hedge. You can utilize that. But we're going to study into the cash market. Why cash market? Because it gave me a longer history. That's where we can study into it. And I'm going to study into the where is the trending of this 10 years yield today. So I'm going to chart up the path. So as it develops, we're able to keep track of the interest rate better. And what I'm going to do is that I'm going to narrow down into the weekly chart. And I'm going to explore the uptrend line. And what I would like to do is that I would like to clone this so that I can create a, as you could see, a parallel channel. And I'm not surprised of any ease in some months to come, but be mindful that the trending of interest rate is still moving up. So that's what I'm seeing in years to come. Until the inflation are convincing to me enough that is at a 2% in a sustained manner. Is there any similarity in today's market compared to those in the 30s? I'm not too sure if you're seeing this, but I'm seeing that the US stocks and properties seems to be overvalued with borrowings, and that is a bubble. And March 2022 banking crisis is a signal of financial stress that is similar to those in the 20s and 30s. And how about for inflation? It is still a wild card. If inflation unexpectedly move up with a lowering of interest rate, I'm expecting more volatility ahead, but definitely as well as trading opportunity ahead. So when will that be? Stay tuned for my coming tutorial. Remember to subscribe to my channel. The market are always telling us on their next move. Join us in our weekly case study and discussion. Click on my profile icon to find out more. Feel free to leave any comments below. I love to exchange ideas with you. Really happy that you stayed through this tutorial. You have many great trading weeks